Hello and welcome back to this channel. Average True Range Indicator ATR. Amazing thing to know about volatility and momentum. ATR talk about volatility, whereas RSI talk about trend strength and momentum. ATR indicator is one of the best indicators that is still lots of professional and millionaires, they're still using it. What is the average true range indicator and how does it work? What is the difference between volatility and momentum? How can RSI complement ATR for trading? And finally, I'm going to talk about how ATR can be used to put your proper stop loss. What is the average true range indicator? Average true range indicator is a strong technical indicator the trader used to measure the volatility of the market. It is invented by J. Wells Wilder in the year 1978. The inventor originally used this indicator for commodity, but later it is used for stock market trading. The period of this indicator is 14 days set by the inventor as a default value, but you can change it yourself as you wish. A shorter period than 14 days generate more trading signal and also more false signal. Period greater than 14 days may generate fewer trading signal and also fewer false signal. Traders love this indicator since they can measure the daily volatility with the simple calculations that only require the historical price data. When ATR is high, that means you have a strong upward trend or a strong downward trend. When ATR shows a smaller value, this clearly indicates that the price have gone in a range bound or consolidation and does not change considerably. So the lower volatility means sideways price action. It means there's nothing happening in the market. If this lower volatility continue for extended period of time, the price action can be interpreted as consolidation, continuation, or possible reversal. Now, how we calculate the average true range for this indicator? There are three ways to calculate the true range value, which graphically can be shown as follow. So there are three methods that are suggested by the inventors. Let's assume that you have these three pairs of candles. This one is previous candle, that is current, previous current, previous current, and each one they have a current high price, current low price, current high, and previous close price, and current low price. Now, to calculate the true range is we have to subtract the current high minus the current low, and this one is the current high minus the previous close, and this one is current low minus the previous close. Now, let's assume that, for just the sake of calculations, let's assume that you get 95 cents here, you get 2.1 cent here, and you get minus 2.5. So what is the true range? The true range is 2.5 because we don't consider the minus. So the greatest numbers that we pick. Now, the period of this indicator is 14. It means that we have 14 candles. Now, we calculate the true range for these two, and then we have to calculate the true range for this and the next one, and this one and the next one, and this one and the next one, and then we will go all the way to 14 candles. Then we have 14 numbers. You add these 14 numbers, you get the sum of these 14 numbers, and then you divide the sum to 14. You get the average true range. So that's how you calculate the average true range for this indicator. Now, what is the difference between momentum and volatility? Some traders believe that volatility means bullish and bearish trend strength or trend direction. It is not. Volatility tell you how much the price fluctuate, and ATR tell you how far the price fluctuate or swing, and not how much it moves into one direction. In high volatility, the candlestick normally have a long upper or lower shadow compared to its size, to the body size, and we see a mixture of bullish and bearish candles side by side in a volatile environment. In a low volatility, the candlesticks are small, the body size is small, with shorter body and no wigs. Hardly you can see wigs. Price action is calm and quiet. Nothing is going on. And the trend is only consolidating rather than moving directionally. Experienced traders are aware that markets move from a period of low volatility to high volatility back and forth constantly. Therefore, this makes ATR an amazing profitable trading tool for those traders that can appreciate the volatility fluctuations and flow within the market. So the good traders, they take advantage and they make so much money in these volatile markets. In low volatility, you should have tighter stop loss order and a smaller target. So what is the definition of momentum? Momentum is the opposite of volatility, the strength of a trend in one direction. In high momentum, we see almost one type of candles, green or red. The candles you see green or red in upward trend or downward trend. You see it a lot in price charts. The candles have a smaller wick and large body, and the volatility is at its lowest level. Most indicators measure momentum, trend direction, overbought and oversold, and etc. Whereas ATR indicator doesn't work the same way and analyzes candle size and how far price has gone on average during a given period of time. High ATR means price moved further, and low ATR means the price didn't move much and the candle become smaller. So remember these definitions that we are going to apply to some chart that you can see the difference much better and clearer. This is your Finance WCP stock H1 time frame. Now this is the example of high volatility. We already talked about it. In high volatility, candle have long shadows compared to its body size. You see bullish and bearish candles, they are side by side. Price fluctuate around the mean, or if you install a moving average, exactly the moving average come like this, and it fluctuate just around the moving average. And the definition of volatility describe how much price fluctuate and swing high and up and down, swing high and low. Look at this one, is higher high, higher low, higher high, higher low, swing higher high, swing higher low, and so on. And from here, it's swing lower low, lower high, lower low, lower high, and so on. So this is the examples of high volatility. And here the volatility is very small. ATR is small because the size of the candles is small, and basically there's no shadows. Now look at the ATR. Here I install ATR with 14 period, and you see that while the volatility is high, ATR is high too as well. Why the volatility is low, ATR is low, and again, in this side, the volatility here is high in downward trend, and you see that the volatility here is, the ATR value is high too. So that is a very good examples of high volatility. This is Yo Finance and BB stock. In this graph, I want to show you the volatility versus momentum. What is the difference between volatility and momentum? So one more time, I want to tell you the definition of volatility. Describe how much price fluctuate and swing up and down around the mean. You see? Up and down around the mean. And momentum is the opposite of volatility and describe it as a trend strength. Trend is strength. So here the momentum is not strong because we talk about it that a strong momentum, all the candles here in downward trend should be red, bearish candle. But you have some green candles and the candle size are very small. So it should be large, large bearish candle. And here it's an upward trend and it's supposed to be green candles, large green candles and no shadows. But you see that there are so many red candles and so many small candles too. So this is not a very strong momentum. So that is I consider as a low momentum. And in a low momentum, all the time, the trend it's going to reverse. In a low momentum, when it's coming down, it will reverse, and it did reverse. Now, while the trend is going downward and we have a downward momentum, you see the ATR is making an upward trend. So the opposite of momentum. And here the momentum is positive, at least relatively positive. And here the ATR is relatively negative. It's negative. So you see that the opposite side. So volatility and momentum, they are not the same. This is Yo Finance WCP 4H time frame. Now that's the example of low volatility. In low volatility, you see that the price basically going sideways. Look, there is not much going on here. And the arrow shows that it's basically the trend is flat. And I installed the RSI and also ATR with the period of 14. RSI in a range band, RSI doesn't do anything as well. You see it shows almost basically no momentum. And also ATR shows a downtrend, so going low. When the volatility is low, ATR is going downward. So that is the good examples of low volatility, and you see how RSI and ATR behave. This is your finance case stock D1 time frame. In this graph, I want to show you the effect of a strong trend on volatility. Now here you see that it's a strong uptrend, and also we have some momentum here. It shows the RSI shows that momentum upward here, and when there is a strong uptrend, there's not that much price fluctuations because the trend is going upward continually without any fluctuation. So the momentum, the volatility is low, and ATR shows that low volatility. And here there is a reversal pattern here, and there's a big gap between these two candles. So this gap shows here as an upward in ATR, and also since there is the momentum is downward, a strong downward here, RSI shows that downward momentum. After that, the price doesn't do much, and it is basically goes sideways and in a range bound. So there's not that much going on. The candles size are very small, tiny, with the lower shadows. So that indicates lower volatility, and this lower volatility he shows the ATR makes a low value. So in two cases the ATR make lower value. One of them when the trend goes in the range bound and there is no momentum, so the ATR makes low. And another one when the trend is a strong upward or downward, then there's not that much fluctuation, and therefore we have a downward ATR. So that's a very good example to show the effect of a strong the effect of a strong trend on volatility. This is Yo Finance BB stock W1 time frame. Now I install in this graph ATR with the period of 14 and RSI with the period of 14. This is uh, a, a downward trend. Now this trend making lower low, lower high, lower low, lower high, and so on. So that is the indication of this trend is downward. But I see that the candles are very small and with basically no shadows. So that is indications of a lower volatility. And you see in general, the ATR makes a downward, a lower volatility too in general. But let's see the RSI and ATR, how does it work with respect to this downward trend. Here, this portion is making it upward, and you see the RSI shows that upward trend. And here, the volatility and ATR shows downward. Again, here we have a slight upward trend. A slight upward trend, RSI shows that, and also the ATR shows downward because the volatility is very low. And also here, there is an upward trend. RSI shows upward and volatility ATR shows downward, and so on. So that is, let's say, where the trend is reversing. You see there is a big gap, and this big gap shows here in ATR, and also this downward trend RSI shows. That is where the traders they make money. This is a downward ATR, and at the bottom you see the trend changes, and so the traders usually they get into the market here and here and also here. So the low volatility is not a bad idea for the traders to make money. This is Yo Finance and K Stock. In this graph, it shows that the trend is going upward. Uh, it's a relatively strong upward trend, but with the big volatility, the volatility is high because it's making lots of fluctuations. Uh, and also, so since the volatility is high, it's making higher high, higher low, higher high, higher low. So the ATR is high too. So here the ATR makes high, and also the trends make an upward. Uh, let's, for example, here we analyze here that the between these two candles, the gap is too much. So you see that high ATR, and after that, you see the candles become smaller and the volatility become lower and lower up to here that the candles basically is a four price doji. So from there, the volatility and ATR is coming down all the way. So so that is a good examples of high volatility and also higher ATR. It shows higher ATR. One of the most important use of ATR is for stop loss. Let's assume at the time of a trade, the price is $20 per share, and the current ATR reading on your chart is 95 cents. A rule of thumb is to multiply the ATR value by 2, means 2 multiplied by 95 cents is $1.90. It's a reasonable stop loss point. So if you're buying this particular stock, you might place a stop loss at a level of 190 below the entry price. It means 20 minus $1.90 is 18.10. Now, depend on the software that you're using. Anytime that the price move $1.90, your stop loss will be moved, shift $1.90 up. Let's say the price moved to $26. So your stop loss is going to be 24.10. Let's say it goes to $30. Your stop loss is going to be 28.10. And if the price reverses back, as soon as it reaches 28.10, your share is going to be sold. You can also set your profit target by adding 3, 4, or 5 times the ATR value to the entry price, to that $20. So this way, anytime the market reach your target price, your share is going to be sold at that price. If you enter the market at a support level, you can put your stop loss 2 ATR below the swing low of the support. And if you are shorting at the resistance level, you put your stop loss 2 times the ATR above the swing high of the resistance. The factor of ATR 1, 1.5, 2, 3, 4, etc. It's entirely depend on the traders to use for stop loss. There are some limitations encountered while using ATR indicator. ATR is open to interpretation and unable to tell you with any certainty that the trend is about to reverse or not. ATR is only able to tell you the market volatility, not the direction or momentum, and it gives you a mixed signal, especially while markets are undergoing pivots or when the trends are at its turning point. That's all, folks. Thanks for watching. Please don't forget to share and subscribe. Take care and see you next time.